Hey friends, hope you're doing well. I am still in Makati, but I've moved over to the Berjaya Hotel now. If you're new to the channel, my name's Oliver. I travel full-time and trade, mostly options. So if that sounds interesting, please consider hitting subscribe to see my future videos. Today I want to talk about trade adjustments. This is kind of a refinement of delta neutral trading where we continue to tweak the position as the trade progresses. So we've already looked at two delta neutral strategies, the Iron Condor and the Broken Wing Butterfly. You can refer to my other videos on those strategies if you're not familiar with them. But these are structured so that when you put the trade on, the delta Greek is 0. For example, this is a delta neutral Iron Condor using 16 and 8 delta for strike selection. So these were structured so that the delta at the money, your directional exposure at the money, is close to 0. 0.2, very, very tiny. So you're not really betting on a move up or down. You're not really affected by small moves up or down so much. And it's purely just to try to capture the theta that piles into the trade. So again, if we look like at weekly steps, and you can see the P&L, the model predicts down here. You sit in the trade, and over time, profit trickles into the trade. This is sort of like a weather forecast, right? It's not perfect, but that's the idea behind these. However, once you're in one of these trades, what you'll tend to find is that over time the delta value will change. So it was delta neutral when you put it on, but maybe you get an up move in the market or something about the position shifts in a way where it's not delta neutral anymore. Now, what we can do is we can continue to tweak and adjust the trade over the life of our position to bring that delta back into control. So I'm going to show some examples of doing that, but it's kind of more art than science. But yeah, let's take a look. Now for this, I'm going to go back and look during this up move. So we're going to go back to May 30th. This is going to be simulated trading, right? So May 30th of this year was the beginning of a bull run. I'm going to pretend that I don't know that, and I'm putting on a Broken Wing Butterfly. All right, so I'm in on-demand mode. So I'm actually going to go a bit aggressive. I'm going to go to 52. It's a little shorter than I normally would, but it'll exaggerate the problems. And I'm going to put on a Broken Wing Butterfly. So I'm going to use 20, 40, 60 in this example. So I'm just going to buy 20, sell 2 of the 40s, and then I'm going to buy a 60. All right, so we're going to analyze this. So here's our 60, 40, 20. Delta is close to 0. I'm going to put on 4 of these. So on a Reg T basis, we're risking about $35,000. Our upside risk is actually quite low. It's only $580. That's the most we could lose on the upside. So here we are, and this is what the SPX looked like this day. And I'm just going to jump ahead a week to save time. So we're on May 30th. We're going to go to June 6th. Okay, so you can see between the 30th and the 6th, the market has moved up a little bit. And jumping over to our analyzed plot, you can see some profit has actually come into the trade. This is our T+0 line. Now, if we had stayed down where we were, we'd be up quite a bit of money, but the market's moved up. We're still up money, right? We're up $1,000. I would not be sad about that at all. However, our delta is now -9. So we can either choose to carry. You can see that it's that downward slope. So now we're directional. We want the trade to go, we want the market to come down. That's where we make more money. We don't want it to go up. So that is delta. That is a directional bias in the trade. We might not want to have a directional bias. We're probably pretty happy that we've made $1,000, but we'd like to be delta neutral again. And at this point, you have two options. You can just pull the entire trade off and take your profit, and you can put a whole new one on. That's a lot of contracts, a lot of commission and slippage, for maybe not a whole lot of extra value, because you could also just tweak the trade just a little bit to get that delta back down to 0. We have negative delta. We've got -9 deltas. What do we know that could be a positive delta change? So one is the put credit spread. The very first thing that we learned about with options trading, right, was a put credit spread. You sell a put and you buy a put further down. I'm going to choose 42.75 for my short strikes. I'm going to use the same strike as the upper lungs here. So 42.75, we want to get rid of 10 deltas. So let's come back here. going to sell the 42.75s. Those are 43. I'm just going to go 5 deltas back. It's an arbitrary choice. So now this is kind of a combined trade. We've got our initial butterfly here being analyzed, and then we are also adding this put credit spread. So if we don't have a put credit spread, we have our minus 10 delta. If we put 1 on, we'll have a minus 4 delta, or we could put 2 on and 1 delta. That's pretty close to 0. Most options traders like to carry a little bit of negative delta, which is a longer conversation. But if we wanted to just be as close to 0 as possible, we could just go ahead and ship this. And what this is going to do, because I specifically put the shorts right where the upper longs were, is it's going to close 2 of those options and then open 2 new ones down below. And what that means is that when it comes time to close this trade down, you have the same number of options contracts on. So I'm not adding more options to generate more commission and slippage when you finally decide to shut the trade down. Now, you do have commission and slippage on this adjustment trade itself, of course, but it's just a way of being a little bit more efficient by picking that upper long. Now, you could do this in other ways. You could put the put credit spread anywhere you want. You could trade it completely on its own. That was one example of adding positive delta, but let's just do one more. So in the video on calendar spreads, as I mentioned that if you put a calendar spread on above the money, then it is bullish delta. In this case, we want bullish delta in order to be delta neutral. Why don't we do that? So here we've got July. I tend to short the month of the broken wing butterfly, and then buy double the days to expiration out as the back long for a calendar. So we're going to put one on right now. If you don't remember exactly what those look like, we have July is 45 days to expiration. Double that's about 90. I'm just going to go ahead and use August though. So we're going to use July. We're going to sell July and buy August. We're going to pick a strike above the money, and calls are more liquid above the money, so we're going to use calls just for that reason. But calls and put calendars are interchangeable. We could put puts at the same strike if we wanted to for some reason. I'm going to start with August. I'm just going to go and find like the 35 delta. So 44.10. That's above the market, which is here at 42.80, right? So buy that one. And then we come back into July, and we're going to sell that one. And that is a call calendar. Go ahead and analyze. So we go from a minus 10 delta, add the calendar, now we're only minus 1. Right? Our P&L is basically the same because we've just put the calendar on. Our theta goes from about 68 to 67, so it doesn't really change. We're not using the calendar to try to boost our theta. We're just trying to cut the directional exposure. Both of these are totally fine. You could do either one. One more thing I forgot to mention when I was recording. When you do these adjustments, it can affect what your open P&L looks like in your broker because you're closing out that one put and then buying a put further down. So, that put might be down. Let's say the put's down $300 and you close it and then you open a new one. You've got a $300 loss on that leg that just kind of vanishes. It shows up in your account balance, obviously, but the open P&L for your position now doesn't reflect that put anymore that you got rid of. It'll make more sense as you start to play around with this stuff, but just keep that in mind. If you're using Analyze like I was using, where you're showing every single trade as a simulated trade in Thinkorswim, then that simulated plot is going to show you the aggregate P&L of all of those positions, even where options may have been removed from the equation. So you'll see that as I go through and start doing Rhino stuff on the channel. So stick around and watch that. Anyway, just wanted to make that clear. This is kind of the foundation for talking about the type of trade that I do. And that trade is based on a trade called the Rhino. So the Rhino was created by Brian Larson some years ago, and it's been adopted by other traders I know, like Bruno Boisson is really quite brilliant with it. And I like it as well. And I do it kind of my own way, but it involves doing these kinds of broken wing butterflies and then hedging off delta, typically with calendars. Now, I do want to mention this style of continuously adjusting. Some people will talk about over adjusting. And I would define over adjusting as if you're making these delta adjustments, like let's say you're in a trade for 30 days on average. If you're adjusting the delta 4 times over the course of that trade, that's probably okay. But if you're adjusting delta like every single day, that's too much. I would say that's over adjusting. In terms of deciding whether you have too much delta or not, I would just keep that in the back of your head that you don't want to be doing this too often. You need to be willing to just carry a little bit of delta at times. Also, in terms of adjusting on the downside, I can and will do it, but I get really nervous when the market crashes down around to this area. I'm much more inclined to adjust the trade by just rolling the entire position back, even though that's kind of a pain. I don't like to be too close to this risk. I really like the analyze features of Thinkorswim and having that graphical view of that T+0 line and everything can be really nice. No other broker that I know of does. Thinkorswim and Schwab are merging, so maybe if you're a Schwab customer, you'll get it. The only alternative on the market, there's a paid product called OptionNet Explorer. It's like $50 a month. Most of my trading is in this style, these broken wing butterflies with layers of adjustments on top. I mainly do it in the Russell, the RUT, and I'll be sharing some of that on this channel. So stick around if that's interesting. And yeah, I will catch you guys in the next one.